Let's face it, the banks profit exponentially off almost everything. Either they're lending you money to buy cars, boats, or real estate, or you're parking your cash safely inside their holding tanks so that you hopefully won't ever need any of their loans. Meanwhile, they're loaning out every dollar of your savings multiple times for a handsome profit while giving you next to nothing to use your own capital. Either way, they win. But what if you could use the bank's strategy for your own benefit? What if you could borrow against your own store of cash, have interest charge work in your favor, and continue to grow your capital as you see it? We're going to show you how to do that through the use of a properly designed whole life insurance policy, something we call the dual asset strategy. To explain this process, we'll look at both sides of the ways that banks use profit using the example of a real estate investor. Remember that the dual asset strategy can be leveraged by anyone, from business owners investing in their business or even consumers who are making major purchases in life. First, let's review traditional bank financing for ongoing real estate investments. You borrow against the property itself to qualify for most of the capital necessary to acquire it. You then must make the payments to pay off that loan and get yourself back to even. When you're ready to invest in another property, you have to prove yet again to the bank your creditworthiness and the feasibility of a property you want the money for. As long as you continue to make your payments back to the bank on their terms, you should be able to continue financing your real estate empire, but there's no guarantee the bank will continue to make this liquidity available to you. The bank has the control and can ultimately pull the plug on your deal. That is exactly why you need to build up your own cash reserves and stop relying on the banks. I found that there are three different types of people: those that hate having debt and would prefer paying cash for everything, those that love harnessing the use of other people's money and finance everything. These first two types are falling victim to opportunity costs, however. They are either paying interest to a third party or losing out on interest they could be earning. Albert Einstein said, "Compound interest is the eighth wonder of the world. He who understands it earns. He who doesn't pays it." The third type of person is following Einstein's wisdom by making compound interest work in their favor. We've already talked about what financing a property looks like. Let's look at an example of someone who prefers paying cash for everything. In order to do so, you first have to save up enough capital in a bank account that earns very little or no interest. Then once you acquire the property, you own it free and clear, and you don't owe anybody anything. Even though you don't need to pay any debt service to the banks for the use of their money, if you want to buy a property in the future, you still have to start over again by accumulating the cash. And where do most people do this? In the bank account. Again, earning little to no interest. Some of you may be saying, wait, when I pay with my own cash, at least I don't need to pay interest for the use of the bank's money. True, but remember that you're passing up earning a reasonable interest rate on your own capital by keeping it safe and accessible inside their coffers. Even if you're earning a competitive rate of return, each time you pull your cash out to purchase the next property, you're interrupting the compounding of your cash. It's as if your cash is a snowball rolling down a hill, picking up more and more snow as you place a big wall in front of it, halfway down the hill, forcing it to stop. Imagine how much bigger it could have gotten had you not interrupted its growth. What's so powerful about compounding is you not only earn interest on your principal, but pretty soon you earn interest on the interest through principals already earned. It creates this wonderful snowballing effect. That's why the curve on the right is a lot steeper than on the left. In fact, when I ask other real estate investors which side of the curve would you rather have, everyone wants a steeper side on the right, but you don't get that without putting in your time on the early part of the curve. You see, it's just a time value of money. Keeping assets continually compounding over time is the key. Most people can't get to that steeper side of the curve because things happen. Whether good or bad, we pull money out of our savings each time you push the reset button on your compound curve, killing your chances to get to the steeper side of the curve. That is, unless there's a way to contractually borrow against our assets at any time for any reason. You can see when we do that the red line comes down, indicating there's a lien against our asset base. But notice that the entire asset base continues to compound up to that green curve. As we pay down the lien against our assets, we actually end up at a higher place in line each and every time. That's really the biggest component to the strategy. The fact that your entire asset base continues to compound in your favor in spite of having used some of it to make those purchases. If you use the strategy to invest in real estate, you're really having your cash work twice as hard. Now you have two assets: a cash flowing property that can provide tax advantages if structured properly, and liquid cash inside a life insurance policy that continuously compounds while protecting your family and assets. We want to continue to educate our real estate listeners and our listeners who are into personal finance, because I think this is what you really want to get into. You really want to take control of your finances. And once you do, you start learning these higher level strategies. And this one we've just discussed is really important. So everybody go out to the dualassetsstrategy.com, schedule the call.